A port in Pakistan, a football stadium in Zambia, an airport in Sri Lanka, a half-built railway in Kenya, and ghost towns in Cambodia. That's all that seems to remain of China's Belt and Road Initiative. Almost a decade after its launch, China's grand ambitions to place itself at the center of the global economy have ground to a halt. Accusations of debt-trap diplomacy, corruption, and incompetence lead us to ask a simple question: has China's BRI failed? To understand the BRI, we have to go back to 2013. President Xi Jinping came to power in 2012, faced with a series of challenges. After decades mired in the Middle East, America announced a pivot to Asia. Washington aimed to rebalance its focus and massive economic and military resources into a growing Asia. For a rising Beijing, having the world's biggest power in your backyard was a problem. Xi also faced a key economic challenge. China's economy had expanded quickly, but perhaps a little too quickly. Chinese firms, especially in fields like construction, had grown tremendously during the nation's economic boom and faced a problem. They were having trouble finding customers. If China was to have any hope of beating America and becoming a global economic power, it would need to look outside its borders for markets. That was when Xi Jinping unveiled the Belt and Road Initiative, or BRI for short. The plan was simple but brilliant, and it went something like this. Step 1. Pour trillions of dollars into developing countries to build out crucial infrastructure and development projects. Developing nations had become fed up with Western countries and institutions like the World Bank. These institutions needed feasibility studies, background checks, anti-corruption measures, environmental protections, and the like. None of that with China. Beijing would lend you money and lend it quickly, with no strings attached and no drama. Step 2. Countries accept the money and start building. There's a catch though. Most of the business and expertise comes from Chinese companies. Developing countries build infrastructure on loans that China gives them, hand lucrative contracts to Chinese firms, and eventually pay back the money at full market interest rates to China. All the companies that were finding it difficult to find work back home in China would find new markets in Africa and Asia. As you might have guessed, this becomes a problem down the line. Step 3. With the infrastructure built, there is a major economic boom in Asia, Africa, and Europe. And who better than the Chinese companies who built the infrastructure to control the flow of goods that transits the newly built trains, ports, and roads? Beijing has successfully built itself into every global supply chain that matters. Mission accomplished. But it wasn't that simple. The beginning was easy enough. Scores of countries signed up. Why wouldn't they, if the Chinese were handing out large sums of money with no questions asked? Deals were signed and work on projects began. That was when Beijing ran into its first problem. Chinese diplomats, businessmen, and politicians began looking at each other and asking a simple question. Who was running the show? Was it China's massive state-owned enterprises, the Ministry of Foreign Affairs, or perhaps the formidable ministries of Commerce and Finance? No one was quite sure, and this led to a bureaucratic mess. Chinese authorities gave the green light to some questionable and ultimately economically unsustainable projects. This coincided interestingly with another problem: the often unreasonable demands of local politicians. A case in point is the Hambantota port in Sri Lanka. After both India and the United States declined to fund the project because they thought it was an economic dud, the Chinese swooped in to fund it. Never mind the fact that Sri Lankan authorities themselves were dubious about the port's unsustainability. After all, Sri Lanka's Colombo port handled the vast majority of Sri Lanka's maritime trade. However, there was a decisive factor. The port was located in President Mahinda Rajapaksa's home constituency. In the years afterward, Chinese campaign contributions flowed to President Rajapaksa's re-election campaigns. If you think that sounds like corruption, you're probably right. China's efforts to build a game-changing multi-billion-dollar train system in Kenya ran into similar problems. This standard gauge railway, which was supposed to slash the travel time from Nairobi to Mombasa port in half, now stands unfinished in the middle of nowhere. The rail line racked up millions in operating losses before Kenya finally bit the bullet and terminated a management contract with the Chinese enterprise managing the railway. The entire project was so immobilized by allegations of corruption that it became a key campaign issue in the Kenyan presidential election. The country now owes Beijing $4.7 billion if it ever hopes to see the project to completion. Beijing, though, isn't all that affected. Many of the high-value commodities like electronics and electrical supplies for the railway were imported from China and cost Kenya somewhere around $720 million. That seems to be the trend with the Belt and Road Initiative. China came in promising less regulation and ended up regulating nothing at all. Projects were badly chosen, deals were hastily signed, contracts were handed out without open auctions to Chinese companies, and developing countries took out loans at full commercial rates of interest. When projects went bad, as they inevitably did, developing countries were stuck with massive debt. Pakistan, Laos, Mongolia, Kyrgyzstan, Djibouti, Montenegro, Tajikistan, and Maldives. These are just some of the countries that have seen debt skyrocket because of easy Chinese money. 42 countries now have Chinese debt that exceeds 10% of GDP. Part of the problem with the BRI is also how the loans are structured. Imagine you're a developing country that's tired of the World Bank and the IMF telling you how to run your economy if you want their money. The Chinese, who agree to lend you money with little to no paperwork, are your best friend. It's only once you sign on the dotted line that the fine print hits you. First, the interest rates. Typically, institutions like the World Bank and Western lenders lend to developing countries with low interest rates. Chinese loans, though, come with a 4% interest rate, about 4 times what you would pay if you borrowed from the World Bank. The second thing you notice is the repayment period. As a developing country, you'd ordinarily have somewhere around 3 decades to repay your loan. Beijing, though, wants its money back in less than a decade. You've now got a pretty good sense of what makes the BRI so toxic. But there's something else you've probably heard about over the last few years: debt trap diplomacy. That's the theory that China wins even when it loses. Let's say your promising project, financed by the power of dreams and Chinese money, has ground to a halt. Unable to pay the massive loans you've taken, you approach your Chinese funders for some sort of accommodation. Beijing, of course, is happy to help, for a price. That would be a piece of strategic real estate, a well-placed port here, or a military base there, that will make up for China's loss. Before you can blink though, China has acquired a series of military installations and economically vital ports in countries that owe it money. Take Djibouti, for example. It owes debts totaling more than 80% of its GDP to Beijing. In 2017, it played host to China's first overseas military base. Sri Lanka has handed a Chinese firm a 99-year lease on Hambantota port after the country proved unable to repay its debt. In August this year, Hambantota hosted Wangyang 5, a Chinese spy ship, despite India's loud objections. Rumors of debt trap diplomacy seem to have doomed BRI. If the initiative was toxic before, it is now positively radioactive. Nepal, Kazakhstan, Malaysia, Maldives, Uganda, and South Africa, among others, have backed away from the BRI. China seems to have acknowledged that the game is up. In just 1 year between 2019 and 2020, Beijing's BRI investment dropped a staggering 54% to its lowest ever levels since the initiative started in 2013. In Africa, home to 40 BRI nations, Chinese bank financing for infrastructure projects fell from 11 billion in 2017 to 3.3 billion in 2020. Is the BRI dead then? In a sense, yes. Beijing's staggering economic losses and reputational damage seem to have triggered a rethink of how BRI is done. Part of the change also comes from how China sees its economic strategy. BRI was conceptualized when President Xi believed that China had to integrate itself with the world economy. That doesn't seem to be the case anymore. The news coming out of China indicates that Beijing is increasingly looking inward. Its top priority is building up domestic markets and self-reliance instead of closer linkages with the outside world. That means BRI will be much less important to China going forward. It will probably continue in some form with less of a focus on hard infrastructure like roads, railways, and bridges. In the end, the real losers are the world's developing economies. Saddled with debt and with hundreds of billions of dollars still needed to fund their dreams of becoming developed nations, the failure of the BRI is just another act in an unfolding tragedy.